Okay, welcome to part three. This is where I just sort of give an overview of what my expectations are for looking at the macro outlook. So, where do we start? The US data continues to surprise. The markets were reacting and are reacting to data as it comes out at the moment. All this sort of previous giving insight into what was going to go on and when by the central banks has had to stop because they're now at a point where they're relying on the data themselves as well. And of course, we had some of that weak data coming in, so traders and investors have then become pretty sure that the rate hikes are done. And then of course on Friday we get that NFP data, which was a real big beat, coming in at 336,000. And of course that could be enough to put pressure back on the Fed to raise rates again. The Dixie sort of had a pretty steady week. It did ease a little bit on Friday to probably around about 106.5. That's the dollar index. It's a basket of currencies against the dollar. Bitcoin rallied quietly to touch almost 29,000, but it still did end up positive at 28,000. So, and we all used to think about sort of crypto, Bitcoin as real high, massive volatility, but just look at all the markets at the moment. Stocks were fairly flat on the week. Again, they did have some wild swings. To be honest, that's probably just Friday, let alone the rest of the week. WTI dropped $10 on the week. Again on concerns about sort of the economy leading to probably a drop in demand. And it traded down as low as in the 81s. And remember, the week before it was up to 95. But commodities have just got that volatility at the moment. And gold continued to make new daily lows as it hit 1822. Again, when you think about it, a few months ago that was trading over 2,000, 2,100 in fact. So data is now playing such a big part again, and it's going to be that's really going to determine if there's any more rate hikes or not. And if you look in the US, the 10-year yields are really sort of zooming close to that 5% level. Just again, that's just sort of crying out that it's not all over yet. So inflation is dropping, but it just continues at such a slow pace. I mean, probably the oil sell-off last week was a real bonus for the central banks because that oil sort of being much higher is going to become inflationary again. So losing $10 last week could perhaps prevent that inflation spike that we was looking for. So when we look at the data, I would say that a soft landing for the US is still pretty possible. I mean, there are a few more sort of economists that are commenting around, perhaps the rate hikes that are going to impact the economy because they're lagging. That could still come back and hit the US perhaps sometime in 2024, which could push them into recession. Personally, at the moment, I don't see that, but again, just remember that's my personal view. Now, as I say, some economists are expecting US rates, if there is a recession, to start to drop next year, possibly by 0.5%, obviously depending on inflation. I was reading last week that there was one bank analyst that was expecting perhaps even a 2% cut by the Fed by the end of next year. I just can't see that, no way, because again, the central bank's going to be cautious because they don't want to boost inflation again. They don't want to boost demand. If they start cutting too aggressively, people are going to think cheap money's coming back and they're all going to go out spending again if they can afford it. And that's not the signal that they're going to want to give. So I think okay, rates may come down next year, but they're going to be incremental, they're going to be slow, they're going to be deliberate, and they're going to be calculated. So after record temperatures during the summer, Big question is, especially in Europe, what should we expect for winter? Mild, colder, or even severe. Now, of course, we can look at the data, we can look at the predictions, but they're not always accurate. And of course, I think this time round Europe is much better prepared for this coming winter, with very high gas reserves. Last year, obviously, it was a bit of a surprise with the gas being cut off. So I still do expect Europe to enter a recession at some stage. I mean, you just got to look at Germany and their lack of performance. Some of that's due to sort of a lack of investment in infrastructure and just internally, but the rest of it is just because of that fall in demand, and especially unless China sort of really picks up, because I would say that Germany rely a lot not just on their European partners, but also on China, because China does like quality goods. Now, if Europe does enter a recession, I just think it's such an unknown at the moment as to how deep or how long that's going to be. So as I just mentioned, China. So China could be the key to this. They finished their golden week. Their data has improved, but only just slightly. Investors have been drawing a lot of money out of China, and that's not something obviously they want to see. But investors need a lot of convincing that their economy's bottomed out, and although some economists are forecasting that they will hit that 5% growth still, it's a big question, and it's a matter of where you see it coming from, because the real estate industry is still dire, and it could get worse, even though they're trying to sort of promote that and boost that by sort of making borrowing cheaper and such like. They've still got a long way to go, and of course it's sort of a one-way street come two-way street, is that if global demand drops, that impacts China, and if global demand is dropping, Chinese demand drops, because they're not gaining the same revenue. So it sort of becomes a little bit of that chicken and egg situation. So the Russia-Ukraine war is continuing, although I'm just thinking that perhaps the weather's soon going to slow any progress there. As Europe starts to head into winter, it's going to make it more difficult for anyone to make ground, I would guess. Of course, drones are playing a bigger part these days, and I don't suppose they worry about the weather. Although I suppose they do to a degree, mustn't they? Because they need to get that signal. Employment is holding up, especially in the US. I mean, just look at that NFP number. It was so big, 336,000. I doubt anyone was expecting that. I suppose after ADP, everyone was expecting it to probably come in a little bit lower rather than higher, and the markets had massive reactions. The stocks were all over the place. But where do we go next? So I think for stocks, then now we're going to start to get those Q3 results being released. I can't see anything except for a mixed bag there. Depending what sector they're in. And again, there's been a lot of corporate greed when it comes to their profit margins. Are they going to be able to maintain them going forward, or maybe Q3 is going to be slightly lower, or maybe it's at the peak going forward? I don't think they're going to have any choice but to slowly but surely maybe give away a little bit of that profit margin to attract the buyers back in, especially as interest rates are going to stay higher for much longer than most expect. Okay, well, unfortunately that's about all I've got to say this week, which will probably please you. And now I'm going to go through and in part 4 do a load of chart analysis and just my expectations and my interpretation of what they're doing and where they could be going. So I hope you'll stay with us for that. So we offer newsletters, we offer workshops, 1 week courses, our comprehensive masterclass that's really going to help you. You know, apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So you know that's you know, I'm not saying I'm going to turn you into a massive trader in 20 sessions, but you know, getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. You know, maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4.